Hi, I'm Lorin Drazenovic, and this is my Go See It project. Walgreens Corporation is one of the biggest drugstore chains in the U.S., operating some 9,600 mostly freestanding Walgreens stores in all 50 U.S. states. Prescription drugs account for about 70% of its sales, with the rest coming from general merchandise, over-the-counter medications, cosmetics, and groceries. Most Walgreens stores offer drive-through pharmacies and in-store health clinics. Walgreens Corporation is the U.S. subsidiary and leading brand of Walgreens Boots Alliances, a pharmacy retailer with more than 18,000 stores in about a dozen countries. My father worked at the Walgreens headquarters in Deerfield, Illinois, and that drove me to conduct my project on them. I frequently go to Walgreens still get discounts due to my father working there in the past. When I go to Walgreens, I can buy basically anything I'd want. Using GAAP, income resulting from partial subsidiaries is reported under the controlling party. The company reports inventory through the use of LIFO, which is allowed by GAAP. Walgreens usually records contingent liabilities in their balance sheet where loss is reasonably estimated and probable. Companies in the U.S. mostly use LIFO, unlike in other countries, a case which could be estimated if U.S. GAAP could conform to IFRS inventory accounting. On the other hand, this would present a problem in that income tax liabilities would be huge due to increase in income recognition. Valuation of assets follows the cost principle at Walgreens. Assets are recorded where cost and depreciation are recorded depending on the market values. The book of accounts is used in keeping records of the assets. This means that assets are recorded minus the depreciation depending on realizable values. Cost principle is applied with the accuracy being put into consideration. Walgreens makes sure that transactions are recorded at the actual price paid for items throughout transactions. The principle is used in all activities that require use of accounts receivable, inventory, and accounts payable. Failure to having this done can lead to inaccurate figures and non-complete accounting principles. Walgreens uses the revenue recognition principle. Revenue is recognized by Walgreens whenever customers are in possession of the company's merchandise. The revenue does not include sales tax, and customers' returns are usually immaterial. Net sales refer to aggregate revenue that is recognized during a certain period resulting from services and goods sold. For Walgreens Boots Alliances Incorporated, the net sales have been increasing since 2012. Whenever customers receive the company's product, the revenues are recognized, which takes place when the customers have assumed risks of owning the product. In summary, revenues are recognized when they are realized and earned, not when cash is received. Products at Walgreens all contain barcodes. These barcodes are used to keep track of inventory at checkout, but they're also used as an internal control. This is done by having detectors at the entrance and exit of the stores. This prevents stealing and helps keep track of inventory. Not only are there detectors, but there's also an abundance of employees working at Walgreens that make sure everything is in order. If anything is missed by these employees, the cameras will sure pick them up. These internal controls are put into place to keep Walgreens a healthy environment for all its customers.